We have the management of Shoppers Stop joining in, Govind Shrikhande, the MD, to talk about this quarter's numbers. Hi, Mr. Shrikhande. Thanks very much for taking the time out. This quarter's results appear to be a slight bit of a disappointment, especially operationally. Could you just take us through the operational performance and especially margins?
I don't agree on the conclusion that it is a slow performance, because let me explain to you how we view the result. So if you look at the standalone result in the department store category, we added 2 stores and we added 13 stores during the whole year, which is really expanding the capacity of the company. We have seen a good like-to-like growth in this quarter, 8.5%, and we have seen a very good volume growth at about 6%. And overall sales is also up at 19%. What we are really seeing is two impacts. One is there's a drop in margin. Gross margin is slightly lower because of the discount period that was there during this quarter. And number 2, the cost in terms of depreciation and interest have gone up because of the large expansion plan that we have taken. So if you look at our EBITDA, in spite of adding 13 stores, we have been able to maintain the EBITDA, whereas the PAT is what has gone down from a 15 crores to 8 crores. And if you do the maths, the depreciation is up by 5 crores and interest is up by 3 crores, which is why you are seeing the net profit coming down at a standalone level. But our belief is that we have been expanding pretty fast pace in the last 4 years. We have doubled the number of stores, and our belief is that the current EBITDA number, which is running at about 5%, as we taper off our expansion plan over the next 2 years' time, it will start catching up and will grow beyond 8%, really taking us back to the earlier profitability level.
Okay. Mr. Shrikhande, this quarter in particular, your top line benefited also from an extended discount season. Once this normalizes, what is a more realistic run rate or expectation that we could expect on the revenues?
Realistically, we believe that the kind of current like-to-like growth percentage that we have delivered, we should be in the same territory, about 7 to 8% like-to-like growth. The capacity addition is continuing, so we'll open another 8 stores in the coming year. And the 13 stores that we added last year, which should come to full traction also in the coming year. So a 20% top line growth is very feasible in the coming year as well.
Okay. Sir, while you did explain what led to this 47% decline in your profitability, part of it is depreciation, the other part on account of interest. But if CapEx continues at such a run rate, your depreciation as well as interest will continue to remain high, which will impact your profits going ahead.
As I mentioned, we believe that 16-17 should be the turnaround period, definitely for us. And from 15-16 onwards, you should start seeing the impact coming up. So from the current 5% level, we believe that again next year with the addition of stores, we should be the same territory. But from 15-16, 16-17, you should start inching towards the 8% EBITDA number that we were hitting earlier. So it's a matter of 24 months from today.
Okay, can you tell us a little more about your expansion plans? You spoke about 8 new stores for FY15. So what's the kind of capex that will go into this, and how are you likely to fund it? And will it aggravate your debt situation a little more?
Last year we generated 140 crores of cash. That whole 140 crore cash will be utilized for expansion. We will be investing about 130 to 150 crores in the coming year. So we don't expect debt to rise too much in the coming year, and our current debt at a total level, if you look at it, is at about 631 crores. So we expect it to maybe grow between 50 to 60 crores considering the expansion and everything.
Okay, let's actually focus on that debt figure then. A lot of your peers, Mr. Shrikhande, are undertaking intensive deleveraging. Is that something which you might look into, at least in FY15?
So basically 2 things. One is our debt equity is still pretty comfortable. We are at a 0.6 debt equity. But the bigger trigger definitely would be the turnaround of Hypercity. And if you look at it, our target, we have been able to hit store level EBITDA positive for the last 11 quarters. Our belief and objective during this year is to hit a company level EBITDA positive. And we are pretty confident that we should be able to do that. And that should definitely help investors to understand the company much better, and the next year's target for Hypercity is PAT positive. So belief is the way we are expanding in department stores and adding capacity with a clear target that we will start hitting a 8% EBITDA plus in 15, 16, 16, 17 kind of a number, and by 15, 16 we'll start hitting positive PAT in Hypercity as well. These are the 2 big triggers according to me for the overall Shoppers Stop outlook.
Okay, well, it is my next question, which is basically Hypercity. In fact, this time we've seen a negative like-to-like growth versus expectations of a growth this time round. While you have turned EBITDA positive, the actual turnaround, according to you, is possibly longer than expected?
It's a 1% negative, but just to clarify, this is not a comparable number, because if you remember, we have been undertaking two big actions in Hypercity. We have been right-sizing the store, so the square feet last year this time versus the square feet applicable right now is much different. The square feet itself has dropped, and that's why the like-to-like is not a comparable number. Overall, it's grown at a 7.5%, and our objective was to also grow the fashion share and drive the margin up, which we have been able to do. So fashion is now at a 13.5%, and it's also delivered a higher margin at Hypercity business level, more than 90 basis point. So that's why at a store EBITDA level, the profit is up from a 70 lakhs to 195 lakhs is what you can see, in spite of a slower like-to-like growth. And we have been able to actually control our OPEX costs also pretty well. They are down by about 5%. So our objective here is not only to drive the top line, yes, in existing stores, but to really right-size the stores, get the merchandise mix correct, and control the OPEX cost to really drive the company EBITDA positive during this year.
I'll come back to Hypercity. Can we hold you to your word that Hypercity will turn PAT positive in FY15?
Yes, definitely. This financial year, yes, 100%.
Okay, great. And just to end the conversation, one macro question. Fashion as a segment has been doing well for retailers, and we know food segment has seen, a bit of a slowdown. So what are the trends telling you going ahead? Have any segments seen a pickup in growth? And also on the impending election, are retailers like you preparing for a revival in consumer sentiment 3 to 6 months down the line?
No, as a retailer, we are always clear that there are two big indicators for us. One big indicator for us definitely is how is the GDP growth shaping up, because it has a direct positive sentiment on the consumers. And if consumers are in a positive or a happy territory, they do tend to spend more than what they would. And the second trend that we keenly watch is how are films moving and how are the films collections moving month on month, week on week. How are the new releases faring? So if you look at it, the GDP growth slowing down over the last 1 year from a 6% to 5.5 to 4.5 does have had an impact on the slowing down of like-to-like growth. So if you look at last year first half, we are running at a 15% like-to-like growth. Second half, we are running at about 9% like-to-like growth, ending the year at about 10% like-to-like growth. So our belief is Q1 definitely would be still soft, because we are still not seeing who is going to come up clearly as a winner. But my belief is second quarter onwards, third quarter onwards, whichever party comes to power will work very hard on the economic growth of the country, and that should directly impact GDP growth, and that would in turn impact consumption story and retail sales as well.
Okay, Mr. Shrikhande, we'll leave it at that. Thanks very much for joining in. So that is Shoppers Stop. It's off the day's high, up around 3% as opposed to while we were talking to Mr. Shrikhande, the stock was up around 4%. So there is some amount of profit booking which has come into the counter. Speaking of